Subscription revenues up 60% year over year, and that's driven annual recurring revenue to over $1 billion, $1.215 billion.
The thesis is that Chainlink will be the default protocol helping to tokenize first cash, called stablecoins, and then all real world assets like real estate, equities, derivatives, and anything else that has value.
If you're not an Indian national, you can't buy Indian stocks. And that's a shame because it's one of the world's fastest growing major economies.
It's not out of the question that India in the coming decade or two might become a legitimate superpower.
Novo Nordisk is a global pharma leader, and they develop and market innovative treatments for chronic diseases. Analysts think it could get to $100 billion a year annually.
The skeptic in me thinks if the investment thesis is banking so much on this relatively new thing looking like a miracle cure, is it too much of a good thing? Are you worried about that?
Online payments get declined less frequently with Adyen than with other payment providers. And what that means is, like when you go and try and buy something from a website, your card doesn't decline.
We wanted to show people what we're doing with a regular little bit of income every month so that we model consistency, and over the years show how quickly that ends up adding up on top of a friendly competition.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to the latest Wall Street Wildlife with Krzysztof and Luke, episode 90. 90 episodes, Krzysztof. And what are we doing this week?
We are going through every single company in our King of the Jungle portfolio challenge, which took us a hell of a lot of prep. And it's so that not only we have a better sense of what we own and why we own it, but so that our listeners and audience can get the very latest of our thinking and what potentially, essentially, are the best buys today.
That's right, exactly right. Between us, we've got 30 companies. There's a little bit of overlap, but like 30 different companies we're going to talk about over the next 2 episodes. We're going to take you through like what these companies do, really high level, like what's our investing thesis for each of these, and we're going to give you our current conviction level. And then we're going to wrap up as well with like rank and stack all of these stocks by our conviction. Heads up, 8 of our stock picks since we started the competition are over 100% return. They're doubles. That was 18 months ago. And one of our stocks, I'm not going to tell you which one, but maybe regular listeners already know, is a 12x return. So hang around for that one.
Right.
And the story ain't over.
Yeah, your 12x makes my 2x's seem like they should be ashamed of themselves.
You got some good winners in there. Like we've got 4 stocks each. You literally just snuck across the line with 100% return, I think, like yesterday or Friday. So we've now got 4 each, which are doubles. That's like a great track record. Should we do a quick reminder of what the King of the Jungle portfolio was, though, before we really get into what the stocks are?
Yeah, I mean, I thought that with today's information overload, when you could go and find information about companies in pretty much anywhere, and then my sense is like people just don't know what to do with all that information. So we wanted to start a way to show people what we're doing with a regular little bit of income every month so that we model consistency, and over the years show how quickly that ends up adding up on top of a friendly competition, right? Where we get to rib each other and buy each other fancy dinners, which, yeah, I won't get ahead of myself. So fancy dinners and, a spirit of competition goes a long way.
We did a check-in like 1 year into the contest. We did a wrap-up a year ago. I was doing pretty well. I was ahead. And now look how close it is. Our current portfolio values are really converging. And actually, even this isn't the true truth, because on this picture, you're about $400 behind. And if we look at today's values, because this thing only updates once a week, You're like $100 behind me.
Yeah, that's crazy. That's crazy. Especially fun fact for you listeners. In Badger's portfolio, he has a what you said, a 12x, meaning it's up 1,100% since you bought it. And that same company, regular listeners will also know, is one I bought an option call on, which ended up expiring at zero. So that cost, the thing that made Badger 1,100% in gains is what cost me money. And yet somehow, seemingly miraculously, I'm only down 100 bananas or so as of this moment.
So before we get into our stocks, let's take a quick look at just the overall picture of both of our portfolios. So here's what our portfolios look like today. You got the monkey banana on the left-hand side. He's got 13 stocks plus some US dollars. And you can see like your crazy over allocation, in my humble opinion, to EOS, 34.5% allocation to EOS. But that's doing well for you because it's returned a 234% ROI. And I guess there's no more sneak peek because you've got the badger on the right hand side. And there's my excessive allocation, 17% to Rocket Lab. And that's my 12 bagger.
You know, just as a preview, when we do each company's summary, we'll sort of we'll sort of present it kind of nice and tight and firmly. And then we'll have a little bit of banter about, you know, what our research showed us, whether we share the same conviction, and a kind of what now. Because looking at, you know, Rocket Lab now, the first question I have is like, should you trim? Obviously, a lot of people are in that same boat. So I'm curious, you know, what we'll discover from talking about each of our positions.
And we're broadly doing them from smallest allocation, or actually worst performer to best performer. So I'm afraid you're going to have to wait till episode 91 for our best performers. So I'm going to give you my Rocket Lab real update next week. But yeah, if you just like between the lines, like if you don't own it today, buy a small allocation, but buckle in for volatility.
One other thing I want to point out is when you look at my holdings, if you include cash, well, it's important. I consider cash a position. So the fact that it's at 0% doesn't mean that it's not a position. I think it's important to have a view of that. But if you strip away cash, I'm holding 13 positions, which is quite concentrated, but to me, that feels good. And you, even though it seems like you have much more, you don't have that much more. You have, including cash, 19 positions. So we are both running pretty condensed, concentrated portfolios for the king of the jungle.
I would argue mine is much more diversified and balanced, maybe apart from my big Rocket Lab allocation, whereas your portfolio, like a third of your portfolio is one stock.
Right. I clearly have five positions which are make up the vast majority of that portfolio. So I'm super concentrated for sure. Shall the games begin? You want to start with? You said we're going to do worst performers in kind of
Yeah.
ascending.
So one of my lowest performers, but it's only because I literally just bought it last week. Let's chat about CyberArk software, ticker CYBR. CyberArk is a global leader in identity security, and they're really focused on the intelligent privilege controls that defend enterprises from identity-based cyber threats, and they secure access from any human or even any non-human trying to get access. So what does that really mean? Basically, they make sure that the right people log into your systems, and they make sure those people have the right permissions they need to do their job. They're a Gartner and Forrester recognized leader in the field, which is more important than ever because of the rise of non-human identities, which now outnumber humans by 80 to 1. What does a non-human mean? They're things like Internet of Things devices, API calls from other software, but increasingly AI agents and digital employees. Financials look really good for this one. Subscription revenues up 60% year over year, and that's driven annual recurring revenue to over $1 billion, $1.215 billion. Currently, it's got a market cap of about $19 billion, which is 17 times sales. So, an expensive stock, but cheaper than its peers. It's a new one in my portfolio, so it's kind of a low conviction holding for me. I'm awarding it 3 badges, 3 out of 10 badges. But I want to increase my allocation to cybersecurity, and I've got a bunch of other high conviction cybersecurity stocks that are way more expensive.
I like it, but I also don't know much about it other than what you've shared on this podcast. But I love the cybersecurity big thesis. You know what this made me do actually over the weekend? This is a little bit of a bracket, but I ended up digging back into Sentinel-1. So for possible future episodes, because I just like how you're thinking about this problem, Badger, especially when we put this in conjunction with your thoughts about CrowdStrike. It seems like there's still smart plays to be made within cybersecurity, but it's going to be more about that confluence of valuation and size and whether they're being overlooked and all that stuff. So I'm glad you brought a new cybersecurity company into the portfolio, into the universe.
Yeah, great stuff. Like, I definitely think if you're a technology investor, you should have an allocation to cybersecurity. I made a really strong argument just last week, I think, for why I think this sector particularly is going to be super resilient to AI. Like, a lot of other software is going to get disintermediated, it's going to get taken over by large language models and AI. I think cybersecurity is going to be one of the last ones to fall. But many of these cybersecurity stocks, like CrowdStrike, like Palo Alto Networks, like Zscaler, like they're pretty fully valued. So when I picked this one a few weeks ago, I was looking for a stock that was a more reasonable valuation. CyberArk is still expensive, but a little more reasonable than the others. So I'm just building my basket in this space.
And a reminder too that I also have Rubric on my radar for the same exact reasons, which showed up on the Gartner chart pretty much right next to cyber. So just thinking out loud, even coming up with a small basket of something like, I'm just Sentinel and Rubric and Cyber as a kind of antidote to the bigger players. That might be an interesting move for down the road.
Yeah. All right. We've got so many to get through. Should we get to our next stock?
Let's do it.
I got a few more than you, so I'm going to do another one, and then we'll start bouncing them backwards and forwards. So my second stock is Greggs. Greggs, ticker GRG.L. They're listed in London. It's a leading British food on the go retailer, and they specialize in value for money bakery products like vegan sausage rolls, regular sausage rolls, sandwiches, sweet treats, and their famous steak bake. It's a 100-year-old company with a strong brand that's embedded in British culture. The food's not healthy, but it's got its raving fans. But it's also cheap. And this could be an asset if we go into a prolonged economic downturn, which is looking a little bit more likely with the recent unexpected tick up in inflation. The company's busy scaling from 2,500 to 3,500 stores over the next couple of years. So there's growth potential, but this is still a good income investment, which is why I bought it. And you got a dividend yield of nearly 4% today. This is a new holding for me. I'm giving this a rating of 3 out of 10 badges, but I want to increase my allocation to income stocks. And I like Greggs. I think it's a good mix of income and growth.
So we just talked income and dividend growth investing um, with the dividend growth investing podcast. So stay tuned for that. So I'm still, it's not really our bread and butter here at Wall Street Wildlife, right? So it's a little bit feels a little bit odd to have this in your portfolio, to see you invest in this. And I think without having as deep an understanding of the company as you do, there's something about it that I don't like. And I'm gonna say, like, it's not that it's income, because I get why you would want to switch over to just more. I don't know if boring is the right word. Just income generating companies tend to not be remaking the world all the time. But my question to you is, out of all the companies in the world, including just the income investing one, is this really the best This really has that special magic alchemy of being so cheap but still growing that you think out of all the other options, this is where you want to get your income from?
Yeah, I think it is. I'm not experienced as an income investor, but I've looked at a bunch of income stocks and I've been trying to find some that I feel like I understand. Like I don't eat at Greg's ever, really. I eat there a little bit to do my due diligence. And I look at the stores wherever I drive past now, like eyeball them, see how many people are in there. Because I'm now owner. I like being an owner of stuff. But like the stores are busy. Like people like this brand. And the reason I'm looking at this sort of sector of, I suppose, like recession proof companies is because I don't know where the world's going. And maybe we're going to navigate our way out of like inflation and financial difficulties, but maybe we're not. And I don't have much inflation proof stuff in my portfolio. And I do think companies like Amazon, Costco, Walmart, like UK like supermarkets that maybe sell at like a lower price point, like Aldi. I think there might be a private company. Like companies like this are going to be more resistant. Like consumer basics companies are going to be more resistant in a downturn. So here's a company that does pay a good dividend, has growth opportunity, like they're planning this big scale out. Like there's a strong argument. I know you're not a Brit and you've probably never seen a Greg's. They're all over the place, like 2,500 branches across the UK. And the UK is not a massive place. So that's quite a lot. It's probably one of the biggest fast casual brands there are out there. It's probably them and a company called Costa Coffee that are probably like directionally 2 to 3,000 branches. Even there's like, that's more than McDonald's. There's something like 1,900 McDonald's in the UK. There's an argument that maybe they're at saturation point already, and this brand will never scale internationally, right? It's a British brand. You might get, as a bit of a joke, like occasional, like a branch in Hong Kong and a branch in like, the places in Spain where Brits go to cause mayhem, but it's not going to scale out at any meaningful way outside of the British Isles. I don't quite buy into the saturation. I do think they've got room to expand. And I see like, there's one location in London, there's like two Pret a Manger's basically opposite each other. I think this has got room to go. And I think you triggered me there when you said it. It's incredibly good value. Like the stock is pretty beaten down right now. So I feel like getting in at a reasonable entry point.
Let me keep pushing back just a little bit more. The fact that you don't like the food yourself is interesting too. So you're just using your investor acumen to say, well, there's lines and it's busy. You're overruling your own, limited anecdote of one, right? So that's interesting, though. I would say in the negative column, all the other things being equal. I don't know. That's just a side comment. But as you were talking, I just thought to ask to find out what the PE ratio is of Starbucks, Chipotle, and Greg's. And now PE still isn't the best metric to use, but it's a place to start. And you're right. I mean, it's so interesting that Chipotle is close to 47, Starbucks is 33, and Greg's is about 11. So you're talking about a difference of 3 times to 4 times as expensive, which is pretty massive valuation difference. Starbucks pays 61 cents a share dividend. Greg's pays 46. What is it? Pence?
Well, you have to look at the dividend yield because it's like
Yeah, yeah.
it's like the cost of the dividend versus the value of a share. So
Right.
yeah, Greg's is about 4% based on today's price. Does Starbucks even pay a dividend?
Yeah,
I
yeah.
don't even
It's
know.
2.6%. So
Okay, that's
so
right.
basically, the dividend yield for Starbucks and Greg's is kind of similar. Chipotle does not have a dividend.
It's quite a big difference. 2.4% versus 4%. That's like nearly double, right?
My data here shows 2.6% and 2.9%, but I don't know if that's currency stuff. Still, Greg's is the larger one, so all other things being considered equal. Anyway, it's such an interesting pick. I got to sit more with this beyond the I don't like it attitude because it's certainly interesting because in that contrary spirit, there's so many good investments are like these kinds of call it ugly ducklings or overlooked and nobody has heard of them, nobody, not many people talk about it, and yet they could really do some good. So props to you for looking into something like this.
Yeah, like if anything, I think Domino's is kind of recognized by quite a few investors as being like a good investment.
Mhm.
I know it was a favorite of our ex-colleague Matt Cochran, and this, in some ways, this is a bit like a kind of Domino's. Like it's unhealthy food, but it has its fans. Financially, it's actually in a pretty robust place. So
Yeah.
you might sort of think of it that way.
Okay.
Yeah.
Cool. Well, good luck, carnivore sausage eater. I do hope they treat their animals well, which I'm almost 100% sure they do not. But
They treat their employees well. They've got like an employee ownership culture, so I quite like companies like that. Like if you work there, like you get like essentially like a share in the company. You start owning stock. You vest stock as you go. Anyway, should we come on to one of yours? And it's not even a stock. What are you going to tell us about?
yeah, this is wild that this is my worst performer so far. I think after today, it's going to be pretty much close to break even, as far as I could tell, based on the latest prices. But still, it's Chainlink, which is a token, so it's not an equity you could buy. And Chainlink is the backbone of blockchain. It's a protocol and suite of security and identity products that is bringing the world's global finance industry onto blockchain technology. Its mission is to provide tamper proof data, cross chain messaging, and compute to smart contracts across any blockchain. Moving money from fiat, which is slow and dirty, to digital, which is instantaneous, transparent, and available to all with internet access. So this is especially timely now because the Genius Act was just passed a few days ago in the United States. And this makes the US economy's move onto blockchain technology lawful and inevitable. Basically, the thesis is that Chainlink will be the default protocol helping to tokenize first cash, called stablecoins, and then all imaginable real world assets like real estate, equities, derivatives, and anything else that has value. The business model is that it will collect revenue for the services it provides as the layer underneath, kind of like more expansive Visa and MasterCard do today. I have saturated myself with Chainlink, Chainlink lore knowledge, especially this past weekend. And the irony of starting with this is because it's my worst performer, but it is my highest conviction, real world investment at this particular moment, especially in light of the passage of that Genius Act. It almost feels, I watched for our patrons, I posted a video where the CEO basically gave, I thought, a pretty good 20-minute summary, and he was asked, where do you think crypto slash DeFi is relative to the start of the internet? And his answer was he thinks it's similar to 97, 98. And I think the Genius Act, which basically, for those that still don't really understand this, because it can be a little bit complicated, it's basically saying that cash, like actual, this is what I meant by dirty fiat, cash, which is still like a physical thing that isn't instantaneous, all cash will now be legally backed by the US dollar and it will be made digital. So it will live on chain. And that basically brings cash onto blockchain technology. So it's the first tokenized example of what it's the first thing to be made tokenizable, cash itself.
And just because you didn't say the word, you're talking there about stable coins specifically.
Yes, correct. And so in this industry, what people have been saying is that stable coins are the things that basically start the domino effect with everything else, kind of like Amazon. To extend the analogy, Amazon started with books, but really what it was building was not a giant bookstore, it's building a massive infrastructure that could basically deliver anything to you, right? That analogy, I think, should make sense. So if you buy this thesis that Chainlink is now working with the world's largest financial institutions, Swift being one of them, that underpins the 12,000 global banks. And it's also working with MasterCard, for example. And it's also working with the DTCC, which is the sort of regulatory kind of company that brings stocks to major markets. Then you could kind of see where this is going. And now that it's law, I don't know. It just seems like a matter of time before the volume of transactions that goes online starts to happen. And then Chainlink is going to take this tiny, tiny little percentage from each transaction. And the way the tokenomics will develop is a little bit of an unknown. But this is the most asymmetric holding I could possibly think of. And I don't mind going on the record to say that if I'm right about even any of this, this is one of those potentially generational investments that you kind of think to yourself, like, oh, yeah, if I understood Google way back when it was starting to do search, or if I understood Amazon, well enough early, then it's that kind of crossroads I think we're looking at with Chainlink.
All right, and I own some Chainlink on your recommendation, and you understand the company and the mission and the token far better than I do. But like, remind me, is there really no competition for this kind of capability? Like, it's sort of, I mean, the high level pitch as I understood it was like they're bridging physical like stuff in the real world and stuff that's nothing to do with blockchain. They're bridging that into the world of blockchain and cryptocurrency.
Yeah, well, see, that's the thing that's mind blowing. My understanding of Chainlink is that it's more of a protocol than it is, say, a company. So, when we think of cybersecurity, there's individual companies that are doing similar things, right? But yeah, there's competition. But like the internet, there's only one, right? You can't have multiple internets because, I mean, it sort of by definition doesn't make sense. And so Chainlink started their mission now. They started collaborating with these major financial institutions years ago. And right now, yes, the answer is that Chainlink has the lead by far. And it's one of those network flywheel effects, kind of sort of like Facebook. Like, why would you, even if technically somebody else created a protocol, why would you not use Facebook when everybody is already using Facebook? So no, not everybody is still using Chainlink, but the players that are most important, these are the guys they selected. It's just that it's kind of, I don't know if this is, it's not that it's in the shadows. It's just that most of the world doesn't understand um, the scope of this. And that's why I'm saying that, yes, if it's true, it's almost too good to be true in a way. And I get why you would ask that the way you did. But from where I'm sitting, it's like, yes, this is the horse that has a massive lead on everybody else, and I don't know what would need to happen for some other protocol to take the lead at this point.
All right, very good. Well, you've awarded it 8 bananas out of 10, so you're definitely it's up there as one of your highest conviction things.
And I'll tell you why I didn't give it a perfect score, despite everything I just said. It's still part of like the crypto world, but when you listen to what the leaders in this industry are saying, is like crypto is like a bad label. It's not really what this is about. This is about bringing global finance into its next paradigm. But because it's such a massive thing that still hasn't happened yet, I just can't say with, utter conviction or like a 10 for 10 that this is going to work because it's such a huge undertaking. It's just that if it does, the rewards are going to be absolutely astronomical. But I thought 8 out of 10 is like, to me, is like, this is as exciting a investment as I could have. And there's still doubt, there's still uncertainty until it's done.
All right, very good. Well, should we talk about another one of mine? And this is also not a stock. Next up for me is the Global X India Nifty 50 ETF. Ticker's NDIA. So, yeah, it's an ETF. It's the only ETF I've pretty much ever owned since I started owning growth stocks. And it gives investors exposure to the 50 largest and most liquid blue chip companies on the national stock exchange of India. Now, if you're not an Indian national, you can't buy Indian stocks. And that's a shame because it's one of the world's most exciting and fastest growing major economies. And the Indian government have some really incredible policies around economic reform, infrastructure development, attracting foreign investment. This is just great for its companies. Initiatives are boosting manufacturing and digital infrastructure. And a really good example, I think, is iPhones. Like Apple are currently manufacturing around 10% of all their iPhones globally in India. And they're planning to grow that to 25%. And that's because of like tariffs. If they manufacture their iPhones in China, which is where they do the majority of manufacturing today, like US tariffs are going to hit that hard. If they manufacture in India, different set of tariffs. Currently, who knows, tariffs on, tariffs off, currently much lower. So it's cheaper for Apple. It means they can sell, like the unit cost of an iPhone is lower. I'm giving this 6 badgers out of 10. I've owned the index since 2023, and I'm continuing to gradually add to it myself.
Hey, Badger, this is showing on the scorecard as what a loss so far of 4%. Is that right?
Yeah, I think it is. I think it is. I had to tweak the numbers, and I'm not 100%, but it's essentially it's like close to zero. It might be a small loss, and like if you dig into the reasons for that, like just global geopolitical kind of chaos. There's also an element of interest rates in here because it's like in a different currency. But yeah, it's not performing well. It was up, it's now down again. Yeah, but long term, and like we're still, it's gonna be a long time before we see the impact of some of these like geopolitical shufflings around, like tariffs and things like that. Plus, a lot of the bull case around India is generational stuff. I think they have like one of the highest percentages of people of working age. Like out of your a billion plus Indians, the large majority are actually in the workplace. So like generating economic value as opposed to being either kids or retired. Yeah, I just think it's a fantastic place to be invested. I haven't got a huge allocation to this in my King of the Jungle portfolio. I've got a 3.5% allocation. That's probably similar to my real money portfolio. But yeah, like I do want some exposure to this particular market, and it's kind of the only way to get it.
So this is based on some small part of our conversation some time ago, right? When we were talking, digging deep into India and just excited about the demographics there, and that it's not out of the question that India in the coming decade or two might become a legitimate superpower.
Well, I mean, they are, right?
Well, yeah,
They've got nukes, they've got like a space
yeah.
program. They're like, yeah, yeah.
Uh, what is it? I see that your conviction also went up when you did this deep dive. Is there something particular that you ended up impressing you more than you expected?
No, not especially. I feel like the chaos and probably like the US driving things like manufacturing out of China are going to benefit companies that can kind of step in and maybe in the future be like the world's manufacturing powerhouse. So, like Vietnam, there's a lot of manufacturing moving there. A lot of other countries in Southeast Asia, well, like India, is now the world's largest population, like past China a couple of years ago. And so I think they're going to get like the lion's share. And currently there are very good, strong relations between the Indian government and the US government.
Okay, I need to put that on my radar again too, because it's something I'm definitely interested in. Knowing that it could be an even better value than what you bought it as is especially enticing. Okay, so my next company is a low performer in my portfolio because I just bought it a couple of days ago, so it's brand spanking new. This is Harmony Biosciences, which is a US biopharmaceutical company focused on developing and commercializing therapies for people with rare neurological disorders. Its flagship product is Wakix, a first of its kind drug approved to treat excessive daytime sleepiness and cataplexy. which is sudden muscle weakness in adults, and narcolepsy, as well as daytime sleepiness in children with narcolepsy. This is a blockbuster drug, and it now generates about 715 million as of last year, and has become a profitable mid-sized player in the sleep disorder treatment market. Why do I really like this company? One, it's the only FDA approved non scheduled narcolepsy therapy drug, 45% share in the US. Its 2025 revenue guide was 820 to 860 million, up 23% year over the year, with a pretty sweet 34% operating margin. And this is the important bit, it has a key readout due this quarter, so basically due by September 30th, that is the company's second go at providing satisfactory data for Fragile X syndrome, which is basically like people with social irritability issues that is actually genetic. And they learned a lot from the first attempts at this study. So this is kind of, it seems like the probability for them having success with this latest readout is more than 50%. Last but not least, should that study not go well and shares drop, because of the massive cash flows that the company has for its Wakix drug, it has a 10% share buyback in place. That's basically like insurance built into biotech, which is a quite rare combination. To pull back the curtain a little bit, as I was preparing this deep dive, there's one company on my scorecard that just made me want to stab myself in terms of like doing deep research, and that was Calumet. I hadn't talked it much because it was such a complicated situation that had to do with aviation fuels, and that is mixed in with policies and administration changes and tax credits. And it was like one of these special situations, plus a Department of Energy loan that went well, but then the stock didn't react well because there was all this game theory around it. I mean, it was just kind of a headache. And I still think that investment will go well for people. That's Calumet, CLMT. But then when I thought to myself, part of investing is thinking like an owner, and to me it's important to sort of have pride in what you own, or at least interest, and in knowing that Harmony Biosciences is a stellar company because it's already profitable and it has this catalyst looming within, call it, the next 60, 70 days. I just thought, why not swap the two, exchange a kind of difficulty and complexity that's unpleasant for financially sound, small cap, big catalyst coming up, insurance built in, and massive upside if certain things go well. And the conclusion I took was, no, there's no reason to do it. I'm gonna like force myself to override the what's called ownership bias, where you treat the things you already own better than the thing that you don't own. And I pulled the plug on Calumet, sold it at, I think I lost $3 in total for the King of the Jungle portfolio. So it was pretty small loss. And now I have a new biotech that I'm really rooting for.
All right, all right. I can't say I know much about narcolepsy. I think my wife might have it, or maybe I just watch really boring movies because she can't get through like a movie on a Friday night. I have to get her doing like star jumps and drinking cups of coffee. But it's clearly I'm trivializing it. It's a serious condition that affects a lot of people.
Yeah, and it's genetic, and there's more research undergoing. One tidbit I want to mention, the reason this company is, I would say, quite undervalued is because there's doubt on whether their cash cow, this Wakix drug, can continue pulling in all the revenues once its sort of right patent expires. But they have in their own pipeline sort of upgraded versions of the current drug on the market. So if those pass the test, then they'll be in the clear through, I think, something like 2034. like another or 10 years. So right now the market is a little hesitant because they're like, yeah, your thing is going to expire and it's your only cash cow because these other the FXS drug is still unproven. So it's the market is depressing shares out of uncertainty. But I think the likelihood of that not working out for Harmony is low. So making it a pretty good risk reward investment in this moment.
And it's a new stock for you, but tell us a little bit about your conviction level.
Yeah, I gave it 5 bananas because it's new. So, I like it takes time to get to know stock and develop a relationship with it. But it's so financially sound. The fact that it has a 10% buyback program for a biotech, company is quite rare. And so the one option I had when I sold Calumet is I could have left it as cash. But I think this is a much better place for cash in this moment. And so I thought that's kind of 5 bananas is, I'm not overly excited for it, but it certainly has many things going for it. So like, it's kind of like right in the middle. It's a great investment to make in this moment.
All right, very good. So I'll say about one of my 5 Badger stocks.
I'm sorry, say that again, Badge?
Oh, let me tell you about one of my 5 Badger stocks, which is also in the biotech arena. Let's chat Novo Nordisk. I've added this to my portfolio quite recently. Novo Nordisk is a global pharma leader, and they develop and market innovative treatments for chronic diseases, but mostly they're focused on diabetes and obesity care through their blockbuster GLP-1 drugs, Ozempic and Wegovy. So the efficacy of these GLP-1 agonist drugs has been revolutionary, and the market is still vast and mostly untapped. Analysts think it could get to $100 billion a year annually. So there's like a ton of growth left for these drugs. But they're in fierce competition with Eli Lilly, and essentially like their blockbuster drugs in this space are going toe to toe. Novo have got Ozempic and Wegovy. Eli Lilly have got Zepbound and Mounjaro. But Novo Nordisk has got a whole bunch of weight loss drugs in the pipeline, including CagriSema and other oral versions of semaglutide. So instead of having to inject yourself with these, you can take a pill. And indications are these could be superior to the drugs that Eli Lilly have on the market right now. But we're going to have to wait and see. In the latest quarter, 18% growth in sales, and that's really driven, or it's been driven by a 65% surge in its obesity segment. So that's really like the piece that's driving this company. And as I said, this is like a 5 bagger conviction for me, 5 Badgers out of 10. I like the combination of income and the potential of growth, but with a current valuation of just under 250 billion euros, this is just 6 times sales, and competitor Eli Lilly is 15 times sales. So right now, you might be picking up a generational company at a bargain price.
That's a good combination. This is also a little bit out of your wheelhouse. It's the only biotech. All these, tell me this, all these weight loss drugs, right? I mean, this is a relatively new thing, correct?
Yeah, last couple of years. Yep.
Is it not possible that things go wrong with this? Like that it's too early to see. Because sorry, it's these drugs. When I hear about them from the news, they almost seem like too good to be true. And I have done some deep dives into it, and it does have that element where people are like, "My God, this could cure Alzheimer's," and it seems to tap into some like root system that's is almost like miraculous, right? But the skeptic in me thinks, okay, if the investment thesis is banking so much of its future on this relatively new thing that's looking like a miracle cure, is it too much of a good thing? Are you worried about that at all?
Not really. Like I said, a couple of years, but actually, like the first drug in this space was Ozempic, and I think that's like getting on for like 8 or 9 years since it's been like out commercially being sold, and these drugs are well understood now. Yeah, I mean, there might be because there are different versions of the same thing still coming to market. Like maybe we're going to find some problem over the decades, but it's like obesity and diabetes Like these are chronic conditions that affect so many people, probably the people eating too much Greg's, right? And Domino's affects so many people. And then, on its own, obesity isn't great, but it leads to so many other conditions like heart disease and strokes and everything else. So, like the impact on people is horrible, it's bad. But actually, if you're running a country, like the impact on the country is really tough because your healthcare costs are through the roof. And whether that's paid by the individual in the US or that's paid by like the state in the UK, like it's still costing something a lot of money to support all these chronic conditions which don't go away. So it's not like, like a broken leg or something, you can just fix it and then someone gets over it. Like typically you've got one of these chronic conditions and you live with it for the rest of your life. So it's costing like the state a ton in the long run. And yeah, you could say to people, oh, well, just eat less and exercise more, but it don't work. And so, as you've kind of hinted, these drugs seem to have a whole bunch of revolutionary benefits, not even on weight, like on your ability to control your state of mind. Like, evidently, I think this is quite new findings. Like, these drugs are helping with other addictive behaviors like gambling and drinking and things like that. So, like, maybe they are revolutionary and maybe they're allowing us to eventually lead the lives that we want to lead. So, maybe something else will come along, but these two companies, Eli Lilly and Novo Nordisk, are at the forefront of this space. And these aren't like, you just told us about Harmony, and I know you have like a bunch of other biotechs in your own portfolio. Like these two companies are giants. Like these are not like one string ponies with which are like sub $1 billion market cap and they live or die by the next drug. Like these companies are selling absolute like tens and hundreds of millions of dollars of these products, and like growth is just continuing to climb. So if this space was going to be disintermediated by an even better drug, like I imagine these companies will be straight on it because they have so much money to spend on R&D and acquisitions.
Yeah, no, that's good in the context of going back to back with our biotechs. It makes sense to me. You just invested in the $250 billion mammoth, right? That has a dividend, right? Which makes sense because you're looking to increase your income, right? Whereas I invested in a $2 billion company that is also financially sound, but it has one product and much depends on the readout of this next product, which is why I call it a catalyst. And so I think in one sense where both of these are sound, but it's just, it's the difference between hoping for 10x versus having an anchor, something like an anchor in your portfolio.
Yeah, that's a good way to look at it. Like the risk-based return, like the risk is far lower with something like a Novo Nordisk, but the return is also going to be far lower and more gradual. And maybe you want, if you're a biotech guy, I am not a biotech guy, maybe you want like a mix of the giants and also a whole bunch of like small allocations to the wild stuff. And then that might be a good way to build a basket.
Hey, listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Shall we talk about my next company with the lowest returns, which is Relay Therapeutics? So, Relay Therapeutics is a clinical stage biotech that applies its proprietary Dynamo platform, combining molecular motion simulations, AI, and experimental assays to design drugs for cancer and genetic diseases that traditional approaches struggle to hit. Its lead asset, Relay 2608, is a first in class PI3K alpha selective inhibitor now moving into phase 3 trials for breast cancer, with additional studies underway in vascular malformations. Although the company's current revenue comes only from collaboration milestones, Relay is backed by about $710 million in cash and aims to fund operations through major data readouts expected in 2027 through 2029. Financially, its cash far exceeds its market cap, giving it a negative enterprise value. Conviction-wise, this dropped through my research, and I want to be very clear why. I have actually never believed in the company more. So let me tie the strings together, the loose ends together. Because their platform lets the scientists see how proteins move in time, which is a very, very difficult thing to do. The way Relay sets up the way they select the molecules, first of all, is head and shoulders above other companies because they're looking, call it more precisely than others are. And then the way they design their trials is superior to other companies. That means their rate of success is going to be higher than most other companies. This matters because, running clinical trials costs a lot of money. So if you could do the kind of work on the back end better, you're going to have a better reward. The data that this particular drug, Relay 2608, currently has in hand is just so far superior to what's on the market now. And we're talking about breast cancer here. So my conviction that this drug will be commercialized and that's going to be a blockbuster in a few years has never been higher. Its current market cap, Badger, is only 600 million. So that's why, when it has 710 in cash, it's selling below, right? It's cash. Why did my conviction drop? It's because it became very clear to me that the next time we can have something like a positive catalyst is going to be at least a year away. And then even then, you're still years away from commercialization. So even though I'm saying at the same time, it's sort of inevitable that this will be a major blockbuster drug worth billions and billions, like to the order of 10x, the market, it's the Wall Street stuff. Like, why would a company right now buy additional shares when nothing's going to move the stock price? And that's why I think it's just a matter of timing, really, why the shares are so theoretically undervalued. Let me say all that in a different way. Relay at 600 million has an easy straight shot to a 10x of being worth at least 6 billion. There's no question about that. Data is in hand, right? But that's not going to happen for a bunch of years. So even if you invest in it today, you're going to overperform the market, say 5 years from now. But then as I'm sitting here and I'm thinking, man, there's a lot of other companies that are already, producing and already performing in the field, as it were. The thought of adding more shares today did not feel right. So this is one of my major holdings, one of my major top 5. And I picked up shares when it was like something $1.80 per share, so 50% lower. I think if we get that kind of scenario again, where the market cap is around 300 million, that's such a no-brainer that I will pick up more shares additionally. But right now, I'm going to put my hands under my butt and just let the months, calendar pages fall off and tend to my other positions. The only caveat I would say is that there is always a risk that they'll announce some sort of licensing deal or some company will buy them out for a huge premium. And that's why I'm not even tempted to selling, and reallocating all that money. This is one of those creme de la creme of biotech, and it's just a matter of timing.
I mean, I'll take your word for it, but the market doesn't agree with you, right? Because it's priced below the cash it has. So I suppose the implication there is, like, if you were able to, say, turn off the company tomorrow and shut it down And that would generate shareholder value closing the company down because the valuation, the market cap is below the cash on the books. Plus, they've probably got some assets and some other stuff, right? So, yeah, the market essentially is saying, well, we think they're just going to set fire to that cash. They're going to burn it over the next couple of years, and it's going to be worth like way less.
I think it's more nuanced than that. Maybe if you're like a robot and you're not like a human person and you just look at spreadsheets, I think that is a reasonable conclusion, right? That we just don't believe this company is going to make it. That's why the value is so low. But as a human investor, I think it's a different story. I don't think many people think this company is going to run out of cash. I mean, they have a runway through commercialization, basically. I think it's really more the situation where it's more about impatience. And, if you're a hedge fund and you want to justify owning this in 2025, knowing it's going to be another 2 years, say, before the next meaningful milestone is hit, then your boss might look at you and say, that's 2 years is a lot of opportunity cost, especially, sure, nothing is a given. Anything could happen, right? But at this point, I'm going to leave it as one of my top holdings because it is so undervalued for the blockbuster that will become that I kind of don't want to get cute and screw myself over with the timing. I'm just going to leave the shares I have and add more only if it becomes even more severely undervalued relative to its future blockbuster status.
But you're using words like top conviction and like highest, like favorite ideas, but you've only given it 3 bananas. Like, can you tidy that up for us?
This is probably the most complex holding I have because it's contradictory. It's contradictory in that I have as high conviction as I have in call it the biotechnology and in the inevitability of success, but it only gets 3 bananas, which is lower than Coherus, say. And Coherus is the much inferior, call it biotech company, because Coherus could actually surprise to the upside in the next month or in the next 2 months or in the next 3 months. And Relay is just not going to do that unless there's a surprise, licensing thing. And so because the banana Badger scale is time sensitive, and we're talking about, we're giving the ratings to right now, the shares of Relay, even though they're massively undervalued relative to their future, it's still going to be a weight. So I couldn't justify that as a neutral. It kind of feels to me like I just won't be adding to this at the relative valuation. So that to me feels like a 3.
All right, well, let me bring us out of the murky world of biotech. So let's talk about like a real company with real stuff that's here today. I'm going to tell you about Adyen, which is a Dutch company under the ticker ADYEN. And they're a fintech. I like fintech. And they provide a single integrated platform for businesses to run their e-commerce, mobile payments, point of sale payments, and you can do that globally. And the single unified platform is really advantageous and really compelling if you're a global merchant, because you're trying to sell in lots of international different markets. And there are literally like hundreds of different ways of paying, payment methods and channels in each of these countries. They all operate in different ways. And if like legacy payment processors and Adyen's competitors, most of them have got a patchwork of different systems for online payments, in-store, regional payments. Adyen built it all from the ground up in-house. So it's fast and efficient, but most importantly, it's accurate. Online payments get declined less frequently with Adyen than with other payment providers. And what that means is, like when you go and try and buy something from a website, your card doesn't decline if it's a legit transaction. It goes through and the merchant sells more product. So a tiny change in the percentage of approved, like non-false positives on your cancelled transactions is actually really meaningful to the merchant because they sell more stuff. They've got now 30 customers doing over $1 billion annually, and that's up from just 19 a year ago. So really incredible growth of their highest cohort of customers. and they are focusing on these large global merchants. I'm giving this 6 badgers out of 10. This is a behind the scenes company that most of us actually interact with daily without even noticing it. It's proven its ability to win and expand wallet share with the world's leading companies, and it's in a great position for sustained, profitable growth for many years to come.
Oh man, Badger, where do I start with this? This stuff gives me a headache.
Not as big as a headache as your damn biotechs, I promise you.
Because I don't understand, for example, like the difference between Adyen and call it PayPal, or I don't know, Block, maybe like Square, Block. Like I'm at a store and I give somebody a credit card. Is it, to me, I don't care. I just want to give some of my money. Is it like just the extent to which some of these companies are more integrated and larger than others, and it's a matter of size? Or
Like you would, as the end consumer, like the guy with the credit card or on your website buying the thing, like you're right, you don't care. You just want to buy the thing you're trying to buy. Like can you remember like the last time you tried to buy something and like the transaction got declined and you had to like phone your bank and then you had to like get it sorted out. Like it's not that frequent, but it does happen. And if it happens online, like the retailer's probably lost your business there because you just want to get something done and move on. And Adyen are just better at minimizing those like incorrect failed transactions. They do a bunch of other stuff as well. They're faster, they're cheaper, and like Square is mostly in North America. Block is mostly used by retailers in North America. Like if you're a retailer and you're selling in India or you're selling in Vietnam, I don't know. I don't think Block is going to be super helpful for you. And it's only certain types of transactions. Like if you want to plug into like some, maybe even like crypto or something, you want to start taking payment in Bitcoins, like Adyen have all the interfaces for this stuff and they do everything well, consistently. And it's really easy as a merchant, you just kind of turn on the payment channels you want to use. With some other providers, you've got like this actual mishmash and you've got like 20 different products for each different market you want to operate in. It's not how you want to run your payments and collections as a global brand. You want it clean and simple.
can you speak at all to PayPal? Is PayPal in the is it a competitor, or is it somehow doing something vastly different?
It does. So I think there's an overlap. I think, is it Braintree? I think is like PayPal's the bit of PayPal that's most competitive with Adyen. But PayPal does like a bunch of other stuff, in my opinion, not that well. Like if you want to do, because it's like, say, if I want to send money to you in the States, you've got things like Venmo and like Square have an option. Like there's different ways of doing that. Adyen's not in that space at all. It's not trying to do that. It's doing like business to B2C transactions if you want to buy something from a company. So I think PayPal do have some products that sit across that space, but I'd need to do some research to pull out the numbers. I think like the cost of using PayPal is higher. I certainly know as a end consumer, if you wanted to send me money and there's like FX involved, PayPal is ludicrous, the amount of FX it charges. It's terrible. It's a really bad solution. But there you're getting more into like Wise, which is a different company I own and we'll cover next week.
It just occurred to me that with the advent of whatever Chainlink is going to be up to, especially their partnership with MasterCard, I wonder if a company like Adyen will also use a company like Chainlink in order to bring their business onto blockchain. So it remains to be seen, especially if it's one of these more like not corporate, but their partners are like institutional level players, right? So that might be an interesting thing to watch out for. And you said your conviction was at 6 badgers with not much that changed for you in this round of research.
Yeah, slow and steady. Like growth is good as like naturally as the company grows, like the rate of revenue growth comes down, but it's been pretty stable at 23%, essentially like mid 20s growth in revenue quarter after quarter after quarter. So nice and steady, and now doing about €500 million in revenues every quarter. So like it's turning into big numbers, and they transact trillions of dollars to make that like $500 million euros every quarter in revenue. So like the amount of money flowing through their systems is boggling.
What's its market cap?
Give me a sec. I shall tell you.
As you're looking that up, it's weird. When talking about a size of a company like this, I want to guess like it feels like something like a $40 billion company.
Yeah, spot on. It's just on 49 billion euros. So kind of euros and dollars are about the same. If you compare that to say PayPal, I know PayPal do different stuff. PayPal's a $72 billion company. I'm not a huge fan of Block because I just really don't think that Jack Dorsey is shareholder friendly. But Block is in the same area of market cap as Adyen, $44 billion.
Okay. So this is another pretty well-established, sizable company. It's not going to surprise the world, but it's going to act as another one of those anchors in your portfolio.
Yeah, and I think actually I didn't say it there, but critically, like it's a Dutch company and it's doing sales globally. Like obviously there's a ton of revenue it generates in North America, but if you want some international diversification, this is a good place to get it.
So my fourth worst performer in the King of the Jungle portfolio competition is also a relatively new addition, but it's already up 14% from when I bought it. I'm talking about Advanced Micro Devices, AMD, which is a global fabless semiconductor company that designs and develops high-performance computing, graphics, and visualization technologies for the gaming, data center, and computer markets. But because compute is now embedded in everything, AMD's products will start to become more widespread than ever across most industries. Think of the AI landscape as the Wall Street wildlife savanna. Older monolithic chips lumber across its solitary rhinos, big, expensive, and hard to maneuver. AMD's chiplets, by contrast, behave like quick-footed meerkats. Meerkats. Markets. That's the second time I got that wrong. Small, modular, and able to scurry into any computational nook that needs filling. Because each chiplet is its own agile creature, AMD can mix, match, or multiply them at will, growing whole colonies for hyperscale inference or dispatching a lean patrol to an edge device. That modular swarm craft turns AMD from a mere chip vendor into the ecosystem's clever keystone species. It isn't just selling silicon, it's weaving the neural sinews that let computation flow everywhere, up the data center canopy, out to the edge scroll band, and even into pocket-sized perches. As inference costs drop and edge deployments stampede, the total watering hole of AI compute will do more than expand. It'll erupt, Badger. In that chaotic habitat, the nimble predators win. Agile outruns brute size, flexibility outwits entrenched mastodons. AMD's chiplet troop is built for exactly that kind of fast evolving terrain, quietly staking out the infrastructure layer of a smarter, automated world, one nimble meat rat mound at a time.
Are you calling Nvidia an entrenched mastodon?
Yes, that's exactly what I'm doing. This is, I gotta say, this is the research deep dive that I had the biggest, what I would call light bulb moment. Out of all the companies that I took another much closer look. Here's the insight, and I don't know, it makes sense to me. This is the difference between, we talked about this some time ago. In the world of AI, you have the massive compute needed to train the model, which I think of as a seasonal thing. It's like you got to stuff a bunch of data in there, make the model, and then once you've done that, it's kind of done. until the next model comes out. But it's like you're doing things in chunks and blocks, right? And for that, you need the biggest and best and most powerful, and that's NVIDIA's chips. And there is no second, right? But that's kind of, I don't know what stage of the AI's evolution we're at, but that's, we're no longer in the first inning with that. But anytime you make a query using AI, you need an answer, and that needs to happen there and then, almost like continuously, infinitely, from now, forevermore, into the future. That is what we call inference, the act of running a trained model in real world applications. So the aha moment that I had when researching this is that NVIDIA, by design, makes mammoth chips. And I mean, to some extent, literally, like their chips are like huge and they're sort of incredibly complex. And yeah, they're like rhinoceroses, monoliths, elephants, right? Whereas AMD, by design, and this took a lot of forethought on the company's part, they sort of seeded, in some sense, seeded the training market to NVIDIA. And all this time, they've been developing, I'm calling them chiplets instead of chips, to differentiate them, smaller and much more flexible and agile, different versions and kinds of chips that could, like Lego blocks, be sort of stacked in different configurations for different use cases, all about the edge cases. That is how you and I will actually use AI. Now, it's not just AI, it's also, anything that could be calculated can be computed and needs chips. So more and more, your refrigerator will have a chip. Your your car, your thermometer. I'm not just talking about learning language models. And for that, AMD's chips are actually fundamentally better designed because it's a whole different application. And so the proof in the pudding, so to speak, is when I see Meta, a company that right now has more cash than it knows what to do with, right? And it's trying to lead the world in AI and creating a metaverse, and it's building its own data center. It's going with AMD. And you have OpenAI, on stage saying, we're going with AMD. These are massive players in the space. So the light bulb for me, Badger, was not that NVIDIA is a bad company. It's just that when I look at AMD's market cap of about 250 billion, and the inference part is the part that is now going to take off, I feel like this is almost the moment we had 3 years ago when you and I were both talking in NVIDIA, and we were kind of like, this is inevitable, and you got to, like a once in a generation thing. And we were right about that. And I think this is the second coming of that exact scenario. The difficulty to understand, or the thing I had to convince myself of, is that you're not investing in like the second best. You're investing in, call it as good as, because it's just a different thing that's needed. And from today's valuations, I'm still sort of, I don't know, I'm kind of excited. I don't know how else to say this. I'm excited that I found what I think is a second shot at investing in the NVIDIA moment, and that the market hasn't quite caught up to it yet, because it's not yet exactly, NVIDIA's journey took a couple of years to kind of, to unfold. Like, I think AMD is like right at that spot right now. So I gave AMD 6 bananas because it's fresh to the portfolio. I didn't catch the bottom. It was recently at 80 a share. Now it's kind of double that. But to where the opportunity is, I think this is going to ride like a decade-long wave in massive, massive potential from here.
Do you happen to know the extent to which like they're going to get smashed by, say, Google? Like on my Pixel phone, Google developed their own chips now, and then they have like their hardware in my phone, and that's where they do inference, like on the device. So do you reckon AMD are then pitching themselves against companies who are like mass market producing their own chips to go in the end user devices?
Yeah, that's a good question, because another sort of thesis that I didn't talk about in the pitch was nobody really likes the fact that NVIDIA has a monopoly. I mean, because the pricing. I'm not sure if it's price gouging, but basically NVIDIA said we could charge as much as we want, and you're going to pay it, right? So I think it's inevitable to some extent that if a company like one of the hyperscalers, if they have enough resources to do something in house, then they will to some extent. So call it Microsoft, Google, Tesla, right? They'll make some chips. But I always go back to the fact that when you have a company that has only one thing to do, they're going to do it better than anybody else can. And this space changes faster. I mean, the evolution and the amount of brain power, engineering brain power, and actual resources needed to get these things to iterate and make it the best of breed is a job for one, I would say. So I don't know. I'm basically not worried about the kind of edge cases of siphoning off some bits of the market to the in-house stuff. But what remains is still going to be such a gargantuan market that even if AMD captures, I don't know, 25% of it, it's like hundreds of billions of dollars of recurring revenue, basically, for the foreseeable future.
All right, good one. I like it. AMD. I've got Nvidia. I own another company in this space I'll tell you about in a sec. I don't own AMD, and it could well be worth a look. Let me tell you about the company I do own in this space, ASML, ticker ASML. ASML is a Dutch multinational that's got a monopoly on designing and manufacturing the extreme ultraviolet lithography machines that help produce the world's most advanced semiconductor chips. So, what does that really mean in English? They make the machines that are used by companies like TSMC and Samsung, and those guys use ASML's machines to make the most advanced chips that are powering everything from AI data centers to smartphones. Now, they're a Dutch company, but US policy has a lot of influence over them. And in the last year or two, they've been forced to really cut back what they can sell into China, and also more recently to stop servicing the machines they've already got working in China. And that's hit the financials in the recent couple of quarters. And at the moment, net bookings, which is essentially like booked revenue plus current revenue, is down quite substantially from a peak of $31 billion, current or euros rather, down to 19 billion euros over the last 12 months. So the valuation has taken a hit. Hang on a sec. I'll edit here. How do I want to wrap this up? Right. So the valuation is taking a hit. I'm giving this a 3 Badger out of 10 rating. Like, it hasn't performed brilliantly, and semiconductors is a cyclical business. And if we are in an AI bubble, and if that bubble pops, the company's going to have quite an uphill battle to come back. But right now, this does feel like a bargain basement valuation, and I'm happy to keep a small allocation as it even pays a 1% dividend yield.
All right, Badger. I'm so glad you're talking about this, because I was looking into ASML myself, and I think my research on AMD, now that I think about it, is going to make me pass on this. And here's why. Tell me if this adds up. If anything I said about AMD is true, then what the world's going to need, in a sense, much more of is the kind of more agile, smaller chips. And if my understanding of ASML is right, the machines these guys make, I think I've heard them be called the most complex machines ever made by humans. Because I mean, they're just beasts of engineering. And if the world is, in some sense, moving away from needing, call it, as many of the NVIDIA type chips towards the more agile ones, then the need for these beasts is going to somehow over time diminish or not grow as fast. Or is that
No, that's not the case. It's not the case because you're thinking about like size, as in, like a big thing that goes in a rack versus a tiny thing that goes in a phone. But that's not what we're talking about. We're talking about like the ability to build chips at, say, a 3 nanometer scale. So that might still be a tiny little chip that's like there's like hundreds of them in my phone, or it might be like millions of those highly precise lithography chips on a much bigger thing. So like AMD, they're fabless, same as Nvidia. So they don't actually make their own chips. They do the designs. They get those designs to be manufactured by TSMC and Samsung and companies like that. Well, those companies are using ASML. So
Okay, so wait, so if I could jump in here, so I think I see the error. Like, just because NVIDIA's chip, call it, is more powerful, all kinds of chips you're saying will need the kind of precision that only ASML, which pushes the boundaries of what physics allows for, right, with the tininess of the lasers. So it's not, so everybody is still going to need what ASML does.
yep, correct. And that really there are no competitors. Like there's nobody else making the machines that can make chips at this scale, as in the precision, not the size.
Right. So
And so that's it. The market locked up.
then it doesn't make sense to me, therefore, why, when we're still so early in the AI world, like why there is the revenue drop off, and why I think the estimates have spooked some investors. If we're full steam ahead, right, and Nvidia is, still knocking, like exceeding expectations, then why would there be this kind of like,
Because they used to sell, and their machines were used in Chinese manufacturing, and they can no longer do that. So they've lost like a big chunk of their market, and they don't just manufacture the machines; they have to maintain them. So they got like the services revenue, and they've lost that as well more recently. I'm sure there are like a myriad other reasons, but that was a big reason for the drop.
okay, so I see you've got a 3 badger rating and your conviction dropped.
Because of that, and because, like, I don't know, I've got a personal opinion, but we might be in a bit of an AI bubble. And also, like, the thesis for ASML depends on companies needing to manufacture more and more and more increasing volumes of chips. And maybe we'll find like breakthroughs, because there are some AI models that are doing, like DeepSeek, are doing more with less, less processing power, less inference, but they're delivering the same quality of results. So maybe there's a ton of model innovation. Now it's a risk, right? It's not necessarily, and if you look at what Meta are doing and what the other Mag 7 are doing, like that risk isn't manifesting itself. These companies are spending more and more and more on chips, on like compute. And so that supports the ASML thesis. But this stuff could blow up. So that's why it's lower conviction for me. Plus, I just like to see my companies performing, and some of the actual metrics are going in the wrong direction for this company. So, I like to buy and add into strength as opposed to doubling down on my losers.
So is it fair to say that your 3 badger rating, as well as a drop in relative conviction, is that you would not uh, buy more shares at these prices now, but it's not bad enough that you're going to sell it off your scorecard?
That's exactly it. That's exactly it. Yep.
All right, I'm gonna pass on the ASML and probably add to AMD. All right. So the next company on my scorecard is an old standby, Coherus Oncology, which is a commercial stage innovative oncology company focused on developing and commercializing immuno-oncology therapies, including its approved PD-1 inhibitor, code name or drug name Lactorzi. The investment thesis for Coherus is centered on its strategic transformation into a fully integrated, innovative oncology company, leveraging its commercial infrastructure, which was originally built for its biosimilar business. The company has recently sharpened its focus exclusively on oncology, a move designed to unlock value and streamline operations. The cornerstone of this new strategy is Lithography, a next-generation PD-1 inhibitor approved for nasopharyngeal carcinoma, which serves as the commercial and clinical foundation for the company's growth. But that's not all. The core of the growth strategy is to maximize the value of Lithography by expanding its use into new indications through proprietary combinations with Coherus's own pipeline assets. The company is advancing 2 mid-stage clinical candidates, CHS-114, an anti-CCR8 antibody, and casdozokitug, an IL-27 antibody. These candidates are designed to enhance the immune response against tumors and are being evaluated in combination with Lithography in high prevalence cancers like liver, lung, and head and neck cancer. Success in these combination trials could create proprietary high value cancer therapies and drive significant sales growth. So, back to the well, I'm going, Badger. This is fascinating because my conviction in Coherus went back up again. I'm bumping it up. It's at 5 bananas just because it is so darn small. It's at $100 million right now. So it's kind of hard, to really, I think, in good faith, give a company this small much more than something like 5 bananas. But in this moment again, it is so potentially undervalued and it's set up for so much success that this is it has a legitimate shot at getting to 10x, because that would only mean getting to 1 billion. And it already has a revenue making drug in hand. So this is how I'm really thinking of it. The Lithography basically has a market of potential like $100 to $150 million in annual revenue. And it's the only game in town for that particular cancer. So now that's just scaling, that's just ramping. So that's already going, right? So they have revenues coming in. They have $250 million in cash now after getting rid of the biosimilars. So the balance sheet is actually quite clean. And they have these two assets that, because they work with the one they already have, they're doing combination studies that in the first half of 26 are primed to give some pretty good readouts. Those combinations, we're talking about markets in the billions of dollars. All Coherus has to do is basically show better data, and any one of the drug companies in the world might look at Coherus and buy them out for peanuts to them, and have in hand drugs that really do well against multiple kinds of cancers. So this is like especially timely. All the biosimilar stuff is in the rare view mirror. And in my King of the Jungle portfolio, I'll be looking to add shares pretty consistently, probably from these price points for the next few months, because the upside is so high and the risk is actually lower than it's ever been, given Lithography's revenue generating capacity. So I'm actually, again, I know you hate to hear it, quite excited about this as an investment opportunity.
Fair enough. Am I right to think like you used to have, this is one of your massive allocations, like a 20-30% allocation, but right now it's down to 2% and you're back in adding mode. Is that right?
Yeah, because if you remember at one point, this was dropped to just it dropped. It was a bit of a roller coaster for any fans of the show. It dropped to measly 67 cents per share, and then it had a good result, sold the biosimilar, and it popped to something like $3. So that was a massive win. So I took a bunch of those shares off the table at a big win, and then the shares started declining again, and it was only around the 75%, the call it sub $100 market cap, that I began reinvesting in it. So this has been me kind of doing a little bit of the slalom and racking the gains relative to market cap, because I know it so well. It's kind of not that hard to do once you know what you're looking at.
All right, fair enough. It's good. As you know, because I've moaned at you a few times, I've got some call options on this one, which are now deep out of the money and have cost me a ton of cash. Well, some of my entertainment money. So I'm glad I didn't sell my calls. Let's see if your 5 bananas comes good for me.
Well, I'll say one more thing, Badger. I did buy a call on this for the King of the Jungle. It's the February 26 50-cent call, and I bought it for 50 cents. That means the break even is $1 due February, and I get 2 earnings call, minimum of 2 earnings calls, maybe a third earnings call in there, and the big drug conference that happens in January for a bunch of upside potential, basically like a free call option, essentially.
Good luck. I'm in this boat with you. All right. I've saved the best till last. My final 2 stocks in this part 1 episode. These are both 10 Badger allocations from me. It does not get any higher in terms of conviction at today's valuation. So prick up your ears. Here's my first one. Amazon, ticker AMZN. You guys, you know who Amazon are. They are the world's globally dominant e-commerce company, but they're also a cloud computing company with Amazon Web Services, and more recently, they're a digital advertising company. So this company's got it all. They have an unbeatable logistics advantage in most of the markets they operate in. Like, no one will overtake them now. They are so far ahead in terms of the ability to go from an order to having something in your hand like hours later, depending on where you live. But Amazon Web Services, the cloud computing side, that's the real engine of profitability. And in the last quarter, AWS revenue growth was up 17% year over year to a $100 billion annualized run rate on its own. And now AWS makes up 62% of Amazon's total operating income. That's super high margin, and it's key to the investment case. But advertising is also becoming incredibly profitable. Like, when you go to Amazon.com and you're seeing adverts on the page, they're making a ton of cash out of that, basically doing ad placements for sellers. And in the most recent quarter, ad revenue was up 19% to nearly $14 billion. Again, super high margin. This is a 10 out of 10 Badger investment from me right now. I've owned it since 2009, and it's still among my highest conviction stocks.
So that trip to the warehouse really did you in good, huh?
You got it. Yeah. Seeing the robots, and they've got like, they may have just installed their millionth robot. I think from memory, I saw that headline. Yeah, like, these guys have got this stuff sewn up.
Okay, so a 10, a perfect rating begs for some pushback, because that's saying, this is as perfect an investment of vehicle as there is, in a sense.
Yep.
I want to throw the law of large numbers at you here. It's what, the 4th largest company in the world?
Yeah, it's a $2.4
Or
trillion company today. So yeah, that definitely that ballpark.
So for me, and this is obviously subjective and relative, but for me, for an investment to get a 10, I would need to feel like the reward, is somehow asymmetrical somehow, or like that I'm getting more alpha than, than the market recognizes. But Amazon, in one sense, is like so well known, and so it's not cheap exactly, right? And it's huge. Are you giving it a 10 out of 10 just because you're happy? I don't know. What are your expectations from this investment? Might be a different way of asking the question.
I hear what you're saying, and I'm going to attack it head on. This is a multi-bagger investment from the current valuation, right? They have so much of commerce, they have so much of cloud computing, but growth, there's still, like, I have no doubt that they will be the world's leading e-commerce brand in 10 years' time, maybe even 20 years' time, right? I mean, do you want to argue with that?
Are you saying they already are not now, or they will become?
They will still, or they are today. They're the world's leading e-commerce brand, and they will still be
Okay.
20 years time.
Yeah,
Right?
I would agree that the likelihood of that is quite strong.
Yeah, right. So, right, and like still there is still commerce going online in many markets. Like e-commerce is massive in the Western world, but it's still under-penetrated in some countries. And like I'm going to say something that's going to sound a bit stupid, but this will probably still be the world's leading e-commerce company in 50 years' time, right? What else is Bezos doing? Now I'm going off way off piste here, right? But what else is Bezos doing? He's building into space with like Blue Origin, right? I don't doubt that like when we have humans on the moon, on like, Starbase Alpha, whatever the hell we call this thing, right? At some point, Amazon will be servicing them. And when we have humans on other planets and in other galaxies, Amazon will probably still be servicing them. Like as they're going to grow as the species grows and as our relentless demand for consumerism grows. You Yanks, right? You spend a ton of cash on just crap and stuff you don't need. And in Europe, we spend a bit less and we're a bit more fiscally conservative. But we're all like, you guys lead the way in this stuff because you're pushing your TV into our eyeballs. You're making all the rest of us like much more consumer centric, and Amazon are just going to profit from that.
I'm thinking of in Austin when I order something, sometimes it gets there in 4 hours.
Right.
So I'm almost in a sense spoiled by, I'm thinking, well, where do you go from there? But I forget that the vast majority of the world is still, Amazon hasn't quite gotten their tendrils into everything. Here in Sicily, there's a little delivery locker that allows me to, because the mailman can't go up the hills and into, so there's a little delivery locker and it worked, like 4 days, 5 days, and I got my thing. But yes, you're reminding me that it's almost like tell me if this rings true for you at all. When Apple already had their major iPhone success and like iPhones were already in everybody's pocket, and then that's the moment where Buffett like doubled down and like bought in, and then the company only went much higher after already was already huge. You're kind of saying the same thing here, right? That despite its massiveness, it's far from even being the middle of the journey.
And it's a reasonable valuation. There's only one company in the Mag 7 that's objectively cheaper, and that's my other 10 Badger stock I'll talk about in a minute.
Nah, you present a pretty good case. You're saying when do you think it might? How soon might it double? What's the earliest you think it could double?
Well, I mean, my investment case isn't that like I'm going to double my money over some period of time. It's just that these guys are rock solid and untouchable. But if they continue, like they're already very dominant with AWS, like that's really where the growth's coming from. And if advertising continues to grow, like they have other revenue streams. It's not like Alphabet, like that's my other 10 Badger stock. It's not like Alphabet where they have these other really quirky like Waymos and other bets. Like Amazon is like they're one company with one kind of big bet, but they've got so much optionality within that bet. Like they're making so much money from advertising, but does it seem intrusive? Have you ever really noticed like ads in your face when you're on Amazon? Like I don't know. Maybe it's me. I haven't. Like it all just feels seamless and it's part of the experience, and I just get stuff that I want.
Yeah.
But clearly they're monetizing that, and it doesn't feel like horrible adverts like popping up in my eyeballs. So they're doing stuff really smartly.
Yeah, no, this is good. I'm glad. I mean, a 10 Badger rating, is something to even for a monkey like me. I got to take that seriously. It'd be
You do not get more badges. That's the most badges. It is, I mean, I don't want to sidebar too much. Like, it is interesting. You have no 10 bananas. Like, we're obviously thinking about this in slightly different ways.
Yeah, I restrained myself. I tried to be reasonable, unlike some wild-eyed, furry, bush-tailed optimists. I rein myself in. All right. Speaking of fluffy, bushy tails, My next company is Nintendo, which just came out with a fantastic new game, Donkey Kong, or Donkey Kong something. This Nintendo is a company that has a deep library of intellectual property that creates a powerful and enduring competitive moat, driving both software sales and hardware adoption. The investment case the market is missing. With the sold out Switch 2 launch exceeding expectations, Nintendo transitioned from selling a new console that required its user base to start from scratch to the Switch 2, which allows for previous generations to play its games and to continue to grow its active user base. So instead of being a hardware platform, it is now much closer to something like Apple's ecosystem that locks its users in for life and can offer additional services and games in perpetuity. Beyond its core console gaming business, Nintendo is also strategically expanding the reach of its IP into other entertainment verticals, a strategy akin to Disney's. The company is leveraging its characters through theme park attractions in partnership with Universal Studios and feature films, such as the super successful Super Mario Brothers movie and a new Zelda franchise that is in the works. This strategy serves a dual purpose. It creates new high margin revenue streams, and it acts as a powerful marketing tool, introducing its characters to new generations and driving engagement back to its core gaming products. It is also exceptionally financially well positioned. It's a cash gusher. What they're going to do with the cash is either grow their 1% dividend or potentially buy back shares. So I could not be more excited for Nintendo, and I've ranked it with a pretty high 7 bananas, which increased during this deep dive that I did.
All right, nice. Are you a gamer? Have you got a Switch, or have you ever played with these things?
I have a very weird relationship with gaming, Badge. I love the idea of gaming. So I buy the consoles and I buy the games. And then I feel too guilty to play them because I should be learning Italian or working on my investing. And then I don't play them, but I think about playing them so the company still gets my money.
Yeah, you switch. Like you could turn the game. You could turn the game into like Italian mode, so you're listening to Italian. Like
Yeah,
you can learn passively that way.
yeah, no, but we talked about. I talked
These
about
characters are Italian, like Mario and Luigi. They're Italian characters.
this is the joke I made on the European dividend growth investment. That while you're off buying sausages, I'm here buying something much more fun. I really love this company in this particular moment. It's an odd company for my portfolio because it's already at $100 billion, but it's actually conservatively run, and I get strong whiffs, Badge, of that moment when Disney acquired Marvel and Pixar and basically became much greater than the sum of its parts. And I think this is what we're looking at here, especially when I could point to this switch from being a cyclical hardware business where you start from zero all over again to the switch two, which basically says, no, we're basically keeping things the same. All you old guys still have your accounts. We're just upgrading, the specs a little bit, but everybody's now welcome. So we're more of a software platform now, locking everybody in and then building the entertainment franchises. And it's just stunning. That Super Mario Brothers movie was the second highest grossing movie in the world. It's like no small thing. And with all these properties, Super Mario Brothers and Zelda and like Donkey Kong, and I mean all of these things, the $100 billion valuation, I always look, could this 10x? And at first I'm like, hell no. And no, this isn't one of my obvious 10x's, but could it like 5x from here and become like the world's premium entertainment company in the age of everything being digital and the younger generations growing up with gaming and online gaming, plus the advent of blockchain and being able to like own your things? This company is perfectly positioned to reap all kinds of rewards, even through recessionary times, because people always need their entertainment. So very high conviction for me at 7 bananas.
I'm not gonna hit it too hard because it's been a long conversation, but it's an interesting to compare it with Disney. So it's kind of directionally about half the market cap if I just did my yen to dollars calculation right. But Disney is like, there is a genuinely like a behemoth with so many different things. But at the same time, like I think Disney have kind of blown it where they've overdone most of their intellectual property, like their characters. They've burnt out like Star Wars and the Marvel universe. Like these movies, most of them are flopping in the box office. So yeah, like if Nintendo, like if it can be smart with its IP and conservative with its IP, but can in the Disney way, like continually like reinvent it for the next generation of kids, then yeah, like
And it's funny you say that. It's not just kids though. That's the weird thing about Nintendo. I don't know how well versed you are with their, but they sell themselves as, the kid-friendly family, but the way they make a game like Mario Kart where adults could get together, and have a lot of fun together, drinking and boozing and playing these goofy character-looking characters, and it's just so much fun. The fact that they pay a dividend, I mean, this company should be so high up your watch list. I'd be disappointed in you. I'd be outright disappointed in you if you don't look more deeply into this one.
I'm gonna say it's not for me, but only because like I am a bit of a gamer. Like confession time. So my friends, close friends, are in Japan at the moment. They just went traveling, and so I popped over to their house and I stole their PlayStation 5 and PSVR because I wanted to play like a couple of different games that like I can't play on PC. But I've realized, sorry, wow, that's thunder in my background. I don't know if you're hearing that. Huge thunderstorm. Hopefully the wife is walking home. So I was always a PlayStation, not a Nintendo or an Xbox kid, I guess. And now I'm like a PC gamer. Like I borrowed the PlayStation, but hey Taj, I've barely used it, buddy. I think I've gone off this like genre of stuff. So I'm sticking to my PC games. I never really got into Nintendo, but I can see it's massively popular. I can see like kids love it, and you're right, like drunk adults love it too.
Yeah, but also like your investment in Greg's, right? You don't have to like sausages for it to be a great
Yeah,
investment, right? So
yeah, totally, yeah. I get 4% dividend on Greg's. I get like 1% on Nintendo. Right. Anyway. All right, let me close out my side of this with my other 10 Badger investment. And I've revealed what it is already, but let me tell you about Alphabet, ticker GOOG or GOOGL. Super high conviction, 10 out of 10 Badgers from me. Tech giant that generates the vast majority of its revenue from online advertising. But they've also got a whole bunch of other bets, plus masses of money they're generating in cloud computing and in AI. Alphabet has got 7 products, each with over 2 billion users. Its mobile OS Android is on 70% of handsets. It is dominant. And that gives it unrivaled distribution. And then beyond advertising, Google Cloud, GCP, has become a key part of the investing thesis over recent years. Last year, cloud revenue surged 31% year over year to $43 billion. The company ended last year with $95 billion in cash, and it's generating over $100 billion in net income for the year. So it's actually the world's most profitable company. And yet, despite all of that, it still trades at just 20 times earnings or 6 times sales. So it is by far and away the cheapest of all of the Magnificent Seven. The market has really misunderstood the impact that AI is going to have on Alphabet. It thinks AI is going to disintermediate it and kill search. This is a misunderstanding. AI is a massive opportunity, not a threat for Alphabet. I've been an owner of this company since 2010, and I added to this position as recently as 2 months ago. This is my highest conviction investment at today's valuation.
oh boy, where do we start? I think you need to explain a little bit more clearly that the what is giving this us this opportunity to get a 10 badger rating, right? You're saying the market's missing it and it's the AI thing. And I am, and for full disclosure, I'm leaning, if not heavily on your side, but significantly on your side. I think you're right about this. To use our scale for a rating to be 10 badgers or 10 bananas, it seems like you have to have like all the faith in the world that this is the case. And on my end, I kind of think, well, I agree, but what if, like, since AI is such a new thing, what if they, something goes wrong, where they sabotage themselves somehow, or they are too, whatever. So I don't know if it's me niggling that maybe this should only be a 9 badger or an 8 badger rather than a full 10. You're out here saying, no, you have no doubt whatsoever that AI ain't gonna touch it. Not only is it not gonna touch it, it's gonna make it a better company. Can you explain that a little bit, like why you're so confident in that?
Yeah, and I'll try and keep it brief. Like I unpacked it in a post on social media a bunch of months ago, and I also recapped it briefly on the conversation with the European dividend growth guys the other day. Everybody thinks AI is going to come in and it's going to stop you. Like when you Google something, you see like the 10 blue links and you go into it and Google get paid a little bit of money, because the whole way advertising tech works is this crazy auction that happens in real time whenever you search for anything, and Google serves up stuff that it thinks you want, but it also gets paid by the people whose stuff appears like in that first page of results. And everybody thinks AI is going to kill that, because the thinking here is that you won't go and Google search for something, you'll ask AI for this thing. Well, how do most people access AI? It's going to be on their phone. And sure, OpenAI are deploying ChatGPT to a whole ton of handsets and they're growing gangbusters rate. But most handsets, nearly 3/4 of all handsets in the world today, all phones in the world, are Android. And Google, like for 2 billion people, like they're using at least 7 of Google's products, things like maps and search and other stuff, like photos and various other products. Every time you touch any one of those Google products, it learns a little bit more about you and your preferences. So you take this vast repository of data, which I think dwarfs the information that a company like Meta has on you and a company like Apple has on you, because most iPhone users have got a couple of most iPhone users have got a couple of Android apps on their phone anyway, because Google Maps is pretty damn good and Google Photos is pretty damn good. Like there are no iPhone apps on an Android handset. Apple are getting none of that data. And I haven't even talked about YouTube, right? Like arguably now the world's dominant media channel, like so much content and so much educational content as well as entertainment content, plus like incredible podcasts like ours, right? It's all on YouTube, and all that data is there for Alphabet to mine for insight. And then you're spending, Krzysztof like watched 30 seconds of this video and he clicked away. He's not interested in that thing. Or he jumped to this point of this video and watched this bit. He's interested in that thing. So this vast repository of data, I'm bringing it together now into the conclusion. When you ask AI using Gemini or using any of your Android tools, because Gemini is built into all of them behind the scenes, you ask a question, Alphabet can lean on that unrivaled data to give you the one answer that serves your needs in a much more sophisticated way than anybody else can, because they know so much about you. But at the same time, the AI result is the advert, right? I gave this example on my social media, but I think it's a good one. I just kind of made it up. It's like, I'm a health conscious guy. I don't like Greggs. I do like healthy food. If I'm like walking the streets and I want to get pizza and I search for pizza, well, Android natively knows, Alphabet natively know that I want a healthy version of pizza, maybe unless I'm really drunk. And so they're going to serve that to me. That's a high intent advertising opportunity, because I'm probably going to go to that pizza place, because it's like when they told me about it, the AI told me in Maps, hey, Luke, here is your recommended pizza joint. It's these guys that do this, gluten-free thing or whatever it might be. I'm probably going to go there because it plays to the stuff I really, really want. And so they can charge that pizza restaurant even more for that advert that was built into the AI response. There's a whole bunch of other stuff. I didn't even talk about Waymo, didn't even talk about all these other bets that could turn into like massive Tesla rivaling companies one day. But that's why I think AI is benefiting Google's ad tech, not disintermediating it.
I buy all that, and I think all the people running Google are some of the sharpest minds, and they're on this. They know, they're not sleeping at the wheel. So it would be for them to bungle this would take some sort of cataclysmic miscalculation, which I just don't see happening given what the company's DNA is. So I think you're right that this is an opportunity in this moment of doubt. And I'm probably going to be a Alphabet shareholder owner soon.
All right. Very good. Nice to hear.
Yep.
10 badges.
Wow. Yep. 10 badgers for Google. So let's close this out, and I'm going to make this brief. My next king of the jungle portfolio position is Bitcoin. I'm giving Bitcoin 6 bananas. I'm not going to say much really about this other than I think it's the world's best money. Gold is still the world's top asset class. I think Bitcoin is going to flip that because of all the regulatory wins in its favor. And if editors could put up the chart on Bitcoin, that's a logarithmic chart, and it's just nothing but up and to the right. And the next sort of, if you look at that and you add one more graph and one more bar or a couple more bars in the same scale, you're getting to $1 million per Bitcoin. So it's just one of those things that's, humans have decided that this is the next version of money. And with so many huge funds buying into it, it's a sort of self-fulfilling prophecy as far as I could tell. And so far, I just bought a tiny little bit for the King of the Jungle. I kind of thought of it as a place marker. I think it was 0.001 of a Bitcoin. It's up something like 25% to date. And it serves, I think, the way gold should, just a little bit of value storage. And but with Bitcoin, obviously it's not just storing value, it's creating immense amounts of it. So it fits in pretty well with my investing thesis. The only other thing I'll add, I suppose, is now that the US regulations are so pro crypto, that there's still so many people in the world that do not have anything to do with Bitcoin or wallets. Relatively speaking, it's kind of the Amazon problem. Because it's in the news, you think people have it, but most really don't. So I think there's still a long ways to go.
Good stuff. And it is more than half of the total capitalization of all cryptocurrency. It's like 58%. And I think it's now a Bitcoin market cap, if there was such a thing, is now $2.3 trillion. That's like a whole chunk of change.
Yeah, it's huge. It's this amazing new asset class that, as the world, in some ways it ties in a bunch of threats, like the whole world is going digital. Like that's why I'm investing in AMD. It's going to be everywhere. Now that blockchains are now, going to be regulated, and they're going to be what the global financial industry runs on, it just makes all the sense in the world to me that I said it before, that this thing is going to flip physical gold because it just makes more sense.
Awesome. Well, that got us through our first 15 of our 30 King of the Jungle holdings between us. Editors, if you could pop up the combined conviction rating picture. So you've seen my two biggest conviction holdings, my Alphabet and my Amazon, but I've got a couple of big ones in there for the second half of the episode, for part 2 of the episode next week. We haven't talked about EOS yet. You've got that coming up, plus ASTS, which we both own. So a lot to listen up for when we come back next week's episode and we do the other half of the portfolio. And these are the stocks that have delivered the most. And then hang around for the end, because the big winner my 12-bagger Rocket Lab. Will it be a 13-bagger, 14-bagger by the time we record next week? Who knows?
Yeah, so we still have a lot to talk about. The real high flyers in our portfolio, really exciting companies. Stay tuned.
Are you ready to become a beast of an investor?
I don't know, Badger. I don't know. I don't know what we're doing here. I'm tired.
Krzysztof's journey ended there.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.